Are you prepared to decipher financial mysteries and find the keys to generating wealth? Have you ever pondered how the distinctions between investing and trading affect your financial journey? Come along for a fascinating journey into the world of finance as we examine the subtle differences between trading and investing. What if you could learn the tactics and methods that skilled traders and investors employ to navigate the markets? Are you curious about the possible advantages and disadvantages of each strategy? Prepare yourself to go on an engrossing voyage of exploration and acquire insightful knowledge that will revolutionize your perspective on accumulating riches. Investing. What is it? Purchasing an asset in the hopes of seeing your money grow over time, such as an exchange-traded fund ETF, mutual fund, or individual stock, is known as investing. People typically keep these assets for years, if not decades, because they invest for long-term objectives like saving for retirement, buying a house, or paying for college. Trading. What is it? Buying and selling financial assets with the intention of making a quick profit is known as trading. These assets include individual stocks, bonds, commodities, exchange-traded funds, and more. Traders may purchase and sell securities several times a day, week, or month. Trading is typically associated with active investing, but technically, you make a trade every time you purchase or sell an investment. Which is more lucrative, trading or investing? This question lacks a simple solution. This is so because it's specific to you and your financial circumstances. Those who understand the markets and how they operate are well suited for trading. Additionally, traders have a higher risk tolerance, which helps them stay focused even during market downturns or when they incur a loss. Those that prefer to protect their cash and are more risk-averse perform better when investing. Is investing easier than trading? Generally speaking, investing is simpler than trading. This is due to the fact that trading necessitates regular market observation and improved comprehension of how assets and markets function. Traders frequently buy and sell assets, which can be as basic as stocks and bonds, on a regular and steady manner. However, they can also be more intricate, such as swaps and futures contracts. Traders need to be able to control their emotions, unlike many other investors. Large losses might be tougher to accept, so this can be challenging at times. The final word. Frequently, people use the terms trading and investing interchangeably, confusing them. But given the striking parallels such as the requirement to open accounts, deposit funds, and buy and sell assets, it's simple to understand why. However, the two are not at all alike. Compared to traders, investors typically have a longer time horizon and are more risk-averse. Traders typically comprehend various assets and marketplaces more thoroughly. Whether you trade or invest, you should understand the risks and rewards that come with each. Trade while moving. Anytime, anywhere. You may now access one of the biggest cryptocurrency exchanges in the world. Trade safely and take advantage of competitive costs and committed customer support. Additionally, you will get access to finance tools that make it simpler than ever to see price charts, control auto investments, examine your trade history, and do fee-free conversions. Join millions of traders and investors on the worldwide cryptocurrency market by creating a free account. Comparing trading and investing. Essentially, there are no differences between trading and investing. Both need creating an account in order to purchase and sell securities. Additionally, each gives you the option to select from a variety of investment kinds in order to achieve your individual objectives. Here are some more similarities between trading and investing. Possibility of compound interest. When you receive returns on your assets and those returns continue to generate returns, it is known as compounding. The value of an investment has the potential to compound when money is invested in the stock market. Time multiplicity improves compounding's power. However, compounding isn't always advantageous, particularly when dealing with shorter durations. Your losses snowball when stock prices decline. You have to reclaim a larger proportion than what you lost in order to make up lost ground. For instance, it will require a gain of more than 10% to return a $100 investment that has dropped by 10% to $90. Compounding has benefits and drawbacks for traders as well as investors, but because trading involves a shorter time horizon for recovering losses, there may be more dangers associated with it. Investing over the long term allows your money to grow and recover after a slump. Possibility of receiving dividend income. Dividends are payments made on a regular basis by some investments, such as some individual stocks and funds. Usually made on a quarterly basis, dividend payments accumulate to 0.5% to 3% of the share value annually. For certain investments, it can account for a sizable share of their overall return, which is the sum of their dividend payments and price rises. Dividend income accounted for 40% of the S&P 500 index's total return between 1930 and 2021, which is a collection of the 500 biggest U.S. companies. You can increase your profits even more if you reinvest your dividends, which is the process of automatically using your income to purchase additional shares of the investment that pays them. Dividends and their compound returns have accounted for 84% of the S&P 500's returns since 1960. Interpretation: long-term investors may benefit from better returns by reinvesting their dividends, but keep in mind that past achievement does not guarantee future outcomes. The intention of outpacing inflation: when prices rise and your purchasing power decreases, inflation happens, acting as a kind of unavoidable hidden tax on your money. In normal times, annual inflation is typically 2.3%. However, between June 2021 and June 2022, it increased dramatically, approaching 10% or precisely 9.1%, significantly weakening the value of each of your dollars. 5. The aim of trading and investing is to generate positive returns. They can help you accumulate wealth if they are high enough to counteract inflation and even outpace it. It might be challenging to make generalizations regarding trading's returns and capacity to protect your purchasing power because it involves a broad range of strategies and investment possibilities. It's crucial to remember, though, that most short-term trades lose money, which makes fighting inflation even more difficult. Compiling the returns on diversified, broad market funds for long-term investors against price increases is simpler. Think about this. With dividends reinvested, the S&P 500 has experienced average annual returns of little over 10% annually for the past 100 years, 8 in a normal year when inflation is roughly 2%. That's plenty to fight inflation and increase wealth. This average annual return helps you keep your spending power even in high inflationary periods. Keep in mind that these are long-term outcomes, so investing money you might need to pay for urgent needs won't help you outperform inflation. Over the course of months and years, the stock market goes through numerous highs and lows. If you invest money that you need to pay for immediate expenses, you might have to sell it for less than what inflation would have taken from you. The distinctions between investing and trading. There are more distinctions between trading and investing besides timeline. Here's another couple. Possibility of loss. There is a chance that you will lose money on any investment. However, there are two issues that traders frequently encounter. The shorter your time horizon is and the more you concentrate your capital into a small number of assets, the riskier it is to buy and sell investments. In the past, the stock market has always rebounded from downturns, but not necessarily swiftly or predictably. Because recoveries can take years, investors who buy shares of companies whose values decline might not have the time to wait for a recovery. Not all firm equities have recovered, even though the stock market as a whole has. As many traders do, purchasing individual stocks increases the possibility that you could lose the money you invest. Conversely, funds that are diversified distribute your investment among hundreds of businesses, by balancing out the performance of individual companies with the higher returns of other companies. This helps to mitigate any downturns that may occur. In order to make money more quickly, traders can also buy more complex asset classes like swaps, futures contracts, and options. They can also employ margin, which is a kind of loan that brokerages provide to traders in exchange for their agreement to put up assets they own outright as collateral. While these strategies can theoretically offer traders more potential returns, they also come with higher risks of loss and possibly even more in the case of margin trading. Tax ramifications. Whenever you make money, Uncle Sam usually demands to have his share. The same is true for trading and investing. However, trading could result in lower tax payments. This is due to the fact that gains made on individual stocks, exchange-traded funds, and mutual funds are subject to taxation depending on how long you own them. If you possess investments that you trade frequently or that you own for less than a year, you will probably pay taxes on the earnings at the same rate that you pay on your paycheck. The long-term capital gains rate is a somewhat reduced tax rate that applies to assets you have owned for at least a year and a day, such as potential investments. If in the long run you incur losses rather than gains, you can use those losses to offset gains on other investments, or you can utilize a strategy known as tax loss harvesting to write those losses off on your taxes. The tax laws that apply to your investments in tax-advantaged accounts, such as health savings accounts, individual retirement accounts, and 401 differ. It is not possible to harvest losses. Time and work. Successful trading may be, and frequently is, a full-time job due to the volume of research and transactions required. On the other hand, long-term investing typically requires a set-and-forget mindset. Investors may be able to easily profit from the historically high long-term returns of the stock market by purchasing a diversified fund or combination of products. They will react to market happenings in real time like traders do in an attempt to outpace market returns, so they're likely to go through all of the ups and downs that the market as a whole goes through. This laissez-faire attitude has potential. Illustration of a portfolio. Trading usually constitutes a small portion of an investor's total capital, not their entire portfolio, due to the high level of risk. As a result, they can place larger wagers without endangering their long-term financial prospects. Subscribe now to dive deeper into the world of finance, trading, and investing with our latest videos and expert insights.